Hello, and welcome to our webinar regarding structured sales and an effective alternative to 1031 exchange. I am Steve Harper, and today I have with me as my guest Rick Danowsky. He's the co-founder of SkySon Financial. Frankly, the brainchild behind this structured sale thing. And Rick, good morning, and welcome to our webinar today.
Good morning, Steve, and thanks for having me.
Oh, absolutely. I have to tell you, I'm excited to be doing this webinar, and I hope that my excitement comes out on the other side, because I know you are definitely limited in how you talk about this, but I think this is a wonderful 1031 exchange safety blanket, a 1031 exchange alternative, a retirement plan. If you are an investor of any kind of real estate, you need to be listening to this webinar today because there's something in it for you. Also, if you're a real estate broker, you also should be listening, because Rick, am I correct that there's something in this for real estate brokers too?
You are, yes.
Perfect.
We can help them defer income let's say they have a large case, and instead of receiving that all in 1 year, we can spread that out, give them a little security, and defer taxes on it as well, probably reduce them. So,
wow. And that's just exciting, because one of the big pitfalls, if you're a real estate professional, is the ups and downs of the incomes. This is a way to kind of smooth out all of those rough edges.
Exactly. Yep.
And not to mention the value we bring to our clients. So Rick, why don't we start with this? Why don't you give me your elevator pitch? Tell us what is this structured sales thing, because it sounds complicated. Maybe you can give me a little elevator pitch on it.
Well, certainly, and yeah, exactly. It sounds complicated, but it's actually probably the simplest, most secure deferral strategy out there. We help people who are selling highly appreciated assets, and usually that's businesses, commercial real estate, ag land, those type of things, and defer their taxes, and in doing so, provide guaranteed payments, reduce or eliminate their capital gains taxes on the sale, and in some cases can provide some tax-free liquidity as well on the back end if necessary. But it's just a very safe way for people to exit in its pure sense. Real estate, which is a great investment, but at some point you want to create a cash flow, and we can help do that in a very secure and tax efficient manner.
Beautiful. Well, I tell you what, this is exciting, and I kind of want to dig into it. I played with some of your presentation, and folks, this is going to be a limited presentation today. We'll have all of the contact information for both Rick and myself. If you want to talk further about this is one of those situations where it's certainly worth a phone call, because this is the kind of thing that you need to let the professional on the other end of the know. And the structured sale professional that you really need to let get a hold of for this is Rick Danowsky, because he can listen to your specific situation and talk about how it works and how it's going to be effective for you. So the purpose is to using a structured sale strategy. I'm going to throw these 6 balloons up here. And Rick, why don't you take us through this slide a little bit? We're talking about the reasons. So why am I going to want to do this?
Right. And like you said, every sale is different. Every transaction, each person kind of brings their own personal situation to it. Some are just simply wanting to keep more, the first, pay less taxes on what took them a lifetime to accumulate and to build, which is, probably 100% of the people.
Oh, yeah, absolutely. Absolutely.
And when you talk about 1031 exchanges, which is an excellent, there's times we say that is your best strategy. If you're just looking to move from one to the other, that's what that's built for. Now they've come out.
But let's talk about that just for a minute, because as a real estate broker, I have to tell you that 45-day identification period, I have seen that be such an obstacle for so many sellers. And I've seen sellers have to settle for properties that they normally would never buy. So, that being the case, can't we have this in place just in case we can't find an acceptable 1031 exchange property?
Absolutely. So what we find is a couple things is when we're brought in and they've entered into a 1031, which really might be too late. Or they're considering a 1031 because that's all they know is available as a tax deferral vehicle. They're not aware of a structured sales strategy. You know, a lot of times, if they're just wanting to get out, they're, you know, in doing this because it's the only way they know they can defer or go into an income property versus, you know, raw land or something they've just been accumulating value or it's been appreciating. They meet with us and see this and say, well, this is what we really want. But you're right. What it used to be, and you can probably attest to this, is you found a property nearby, you could go look at it. It was a good property, but there's been so much. People are buying in California, buying land sight unseen in Florida because they're over a barrel. And especially if the seller knows the funds are in a 1031,
absolutely,
they've got you, you know, and
yes.
So they'll just wait and you'll overpay and it might be land you can't even look at or property. And it's just not a good situation. You're kind of over a barrel.
Well, and
so
the
we
sellers
can
are
either be,
even,
like you said, a safety blanket if done correctly at, you know, up front, to where if you can't identify that property and you're really wanting to do a 1031, but like you said, it just can't get done for whatever reason, we can still mitigate the taxes on that. And you can, you know, if you want to buy a property in the future, you have cash flow and you know, that you can go to buy, you know, a good property at that time. Or simply have a, you know, a long-term cash deferral strategy as a fallback or a safety net, so to speak.
Absolutely. And I'll tell you, these sellers are getting smarter too. So they'll ask for proof of the 1031 exchange. And when they receive that proof, it says the date that the 45 days began. And it also says the date that it's going to be coming up. So what do you think that seller's going to do when you get to the last 10 days and that buyer finds something very serious they need to negotiate about? They've got them over a barrel.
And the other thing is, it works in conjunction. So like if you have 10 million, let's say, in 1031 exchange proceeds, you don't have to, it's not an all or nothing. So you might find a $5 million property. What do you do with the boot? We can defer the taxes on that. So we work well in conjunction with a 1031 or in lieu of, or as a safety net. So
utilizing your $10 million example, if we had $10 million in exchange, we find an $8.5 million apartment building that's perfect, but that seller's just sour on the idea of a bunch of smaller properties, and they're sour on the idea of paying capital gains, depreciation, recapture, and everything that comes along with that $1.5 million in boot. They can simply structure that. And we're going to get into what that means to structure it. Because I've mentioned this to people who've heard about it, and they've said, yeah, but you know what? I don't want to carry paper when I make my sale. And I say, no, you need to call Rick. That's not how it works. So we're going to get into that in these future slides. So let's talk a little bit about what a structured sale is. This everyone knows that the 1031 exchange is basically a 1031 exchange because of the Internal Revenue Code section 1031. This is very similar, correct?
It acts in the same way as there's that intermediary or third party that is used, you know, and you use that in a 1031, so there's no constructive receipt, you know, by the seller. So we use this, it's the same concept, it's just called an assignment company, and it's governed by 453 rather than, you know, 1031.
Okay.
And what I'm saying here on this slide is a lot of people, you hear structured sale, and if they're not familiar with it, they think, oh, this is a brand new product or something, and it's not. Nothing is new here. Installment sales have been around since, I believe, 1918. It became Section 4, I think it was Section 211 or 213 back then, but in 1943, it became Section 453. So they've been around a long time, and IRS has no problem, you know, and they're well aware it's for the deferral and reduction of taxes. And then all we do, we combine that with substitute obligor. This is Revenue 82-122, but the first revenue ruling was in 1975, 75-457. But so not new concepts. These are concepts that have been tested in tax court.
Tried and
actually have rulings approved to do. And that's all. This is all we do.
Perfect. And again, these are tried and true. These have been around forever. And this is your business. That's what SkySon Financial does.
Correct. That's all we do.
Perfect. So again, it gets them the tax deferral, the flexibility, guaranteed payments. What is enhanced creditor protection?
Well, enhanced that's on there, and so let's take that 10 million example. If you were to sell it, people tend to hear if you win the lotto, or or you may have legal trouble in the future or medical issues, and you have $10 million, that's subject to creditor. They can go after that. Here, it would go to the substitute obligor, and nobody could ever go and attach that principal sum that would go to a qualified intermediary in a 1031. Creditors can't go after that. They can only wait for payments as they come out. So it protects that corpus of funds from even the federal government can't go after it, because that is the principal trust, who is our substitute obligor here, owned by Principal Financial Group. It's their money, and they have assumed the obligation, substitute obligor, to make the future payments.
So you're kind of sheltering that $10 million in that $10 million example. If we were to put the whole $10 million into this installment sale situation, really the only thing that could be attached in the event of a legal issue or a lawsuit or whatever, they can only really look at the payments that are coming out of it.
Correct, and it's get in line. So what it does, if let's say it was a lawsuit, it gives you tremendous leverage as well. Nobody wants to wait over 10, 20 years to get, they're going to negotiate a smaller amount to get a cash payment. So it gives you leverage, and, hopefully none of that ever happens and you just receive guaranteed payments as agreed to over time, but it does give you that enhanced protection.
Perfect. Well, let's talk about how it works, because I know that there's people out there right now, they're listening to this and they're saying, okay, that's great. I understand how a 1031 exchange works. Now, how does it work with, say, a conventional sale? I was talking to a client about this, and they kept stopping me saying, no. I don't want to take installment payments when I sell my property. I'm like, no, you enter the contract just like you normally would. Is that correct?
Well, yeah. Now, this is for people who want to receive payments.
Well, no. What I mean is my client does like the idea, or this particular client did like the idea of receiving payments, but they didn't want to accept just the person buying their property making them periodic payments.
They don't want the risk of buyer default.
They don't want that risk. No.
Correct. So that's what we kind of have corrected everything wrong with an installment sale. So but it must start. So many times they come to us, hey, Stephen, you come and you say, I've got a client. They're selling a commercial building, $5 million. The buyer agrees to $5 million, but I introduced this concept. You haven't closed yet, but you're saying, they've agreed to buy and sell, and they've agreed to the price, right? So you've got a contract in place. So what we do on the next slide, this is, we're not involved in this. So what we do is we get involved, and we work with both the seller and buyer and their tax advisors and say, look, we're going to do an addendum to the contract and make it an installment sale contract. So now the seller wants...
Isn't that the same thing we do if we're doing a 1031 exchange?
Pretty much, yeah.
We attach the same kind of language to our contract.
Correct. It's just instead of one payment into a new property within 180 days, we're making multiple payments over multiple years. It's the exact same concept.
Okay.
So what we do is make it an installment sale. So a lot of times, and you can tell me, do you ever have a situation where the seller wants future payments, but they're worried about risk of buyer default, and you got a buyer who wants to pay cash?
Absolutely.
Okay, that's very common.
Absolutely.
Here, everybody can get what they want, because when we come and explain, the seller's going to say, let's say it's $5 million. I want $500,000 in cash at time of sale, and then I want $4.5 million deferred, and the payments are going to be X over 10 years.
And that's common. A lot of folks that have built wealth over time, their whole strategy, when you talk to them 20 years ago, was I'm going to buy this, acquire these properties. And then when I'm ready to retire, I'm going to sell them. I'm going to pay Uncle Sam his piece. I'm going to keep some cash, and I'm going to set myself up a situation where I have a secure income. Right.
And you're looking at, so if you pay cash, I can guarantee you'll pay the maximum tax rate.
Absolutely.
And then you have to invest and pay an investor, and then just determine, a secure investment. Most of our clients are 60, older, they're cashing out. So it's not the return on their money, it's the return of their money. They're looking for secure cash stream. So it's just don't lose it. I've built enough. And so we create that stream. And the buyer agrees to it, and it's a step-by-step process. So, we do that, and the seller is going, yes, but I want to pay cash. So immediately thereafter, the buyer says, okay, principal trust company, here's the funds, and all the funds will be in escrow at closing. And they say, I'm going to direct that $4.5 million to principal trust company. There's a 2-page agreement listing the payments, exact payments that are in the sales agreement, and they walk away with title. It's fully funded. They're done. So in essence, it was a cash purchase for them. However, because now there's that intermediary or principal trust company, the assignment company, they're making the payments on the buyer's behalf. But title transfers, there's no risk or obligation in the future to the buyer. The seller is looking to principal trust company to make those payments.
Well, that's achieving everything without paying all of those capital gains, depreciation, recapture. I mean, I know there's some taxation that's involved, but you are avoiding all of those, the right. Higher tax rates.
Right.
Yeah.
Right. Because capital gains are a progressive tax, just like income tax. By spreading them out, you not only get the value, of time value of money and spreading those taxes out, but by spreading them out, we can reduce the amount in the year in which they're paid to lower brackets. And sometimes we have, depending on the individual's overall financial situation, there is a 0% federal capital gains. And we have clients that are paying 0% federal capital gains.
And again, I want to touch on this with the periodic payments. So let's say someone has $5 million and they're putting it into one of these and they're going to assign it through principal trust. What if they end up in a situation where they really don't need any payments for the next few years, but they want them to start later, and they might want those to be a different payment over time? Is that allowed?
Yeah. So what we can do, let's say they own multiple property and they're starting to think about their future, and they say, I've got a really good offer on this property, but I don't really want to retire and I don't need the money for another 5 years or 10
Right.
years. So we can sell it today, take it, lock in that price. You got a good offer, and you don't know if you're ever going to get another one, or, properties, if you don't keep putting money into them, can decline in value, or they need, whatever.
And don't forget the cyclical. Don't forget our cyclical market, because I do believe, that we're coming into a market change as we speak.
Exactly. So you kind of get it while the getting's good, but you can defer that. You can say, I don't want to receive any money for 5 or 10 years. So whatever date, you can say, on my birthday in the year 2027, and we will start the payments then. And so you'll defer any recognition or taxes until those payments start. And again, they're all guaranteed.
In my situation, what if I looked at that and I said, you know what, in 2027, I only want $5,000 a month, but then starting in 2030, I need $15,000 a month. Is that allowed?
Yeah, we could do multiple payment streams. It's whatever is agreed to in that sales contract. I mean, because this is not an investment. This is not subject to ERISA or any of those retirement plans. If you agree to, I want $15,000 in 2027, and then in 2028, I want, X amount per month thereafter, we can do that. We can do multiple streams.
Wow. So again, this is a very, very, it's a very cool tool. It's a wonderful retirement tool. And again, some folks that might not even be aware that this is out there, that they think that they either have to pay taxes or they have to 1031 exchange. This is a great alternative as well as a safety blanket.
Correct.
And I do want to get back. I know that you're taking us through how it works. Right. So now we're talking about the assignment company purchasing. Go ahead.
Correct. Yeah. So when principal receives, it's wired. Everything is direct. We market it. We own, the company, and we're own the trust. But principal trust, we never touch money. So that would be wired directly from closing at escrow to principal trust company. And that same day, what insurance companies do is take money, invest it, and guarantee the payment. So, but we go a step further and say you can only invest in guaranteed products, no AAA bonds. Because if you look at it, we don't want to, or nor does Principal Trust Company want to have to dig in our own pockets if the market goes down. So
no, and truly, the principal, the person doing this, doesn't want volatility in something like this. Generally speaking, they're looking for secure, assured retirement income.
correct. And reduce taxes.
And well, always reduce taxes.
Yeah,
absolutely.
So yeah, what they do is, we'll go out and buy U.S. Treasuries, and we buy and hold to maturity, so that they're never traded, so we'll, for every payment, and then we will actually send a list of the QSIP, so you can see, your CPA can go in and look at at TD Ameritrade, the bonds that are being held, you can actually go see them, and as those mature, the payments are made. So we know to the penny, no matter what, those payments will be made. Or if it's an annuity, those are guaranteed and backed by state guarantee associations and tremendous, 650, Principal has $655 billion in assets. Plus there's a $60 million bond on every transaction. So
pretty solid.
You are virtually oversecured.
Yeah, very, very secure. So,
Yeah.
so also, and again, you pointed this out, and I do want to put a little spotlight on this. SkySon Financial, Rick, you work directly with the clients as well as their CPAs to come up with the best strategy for them from a tax standpoint, don't you?
Absolutely. We won't do it without meeting, unless we have a disclosure form that says we've met with your, because we want you should understand any strategy that you do. I think you would agree with that, whether it's ours or anything else. That's why we're doing this today. But we're going to meet with your tax advisor. We are not tax advisors, so we make sure that your personal trusted tax advisor fully understands the strategy and the process, and is on board with it. And we'll work with both the buyer and seller throughout the process. So everybody's comfortable moving forward.
And for those of you listening that have followed anything about myself or Dusty, know our background. I know some of the folks that are on this do. My trusted advisors, real estate attorneys, mentors have actually met with Rick. They've interviewed Rick. They've given it their thumbs up. All of the people that I trust, which is why we're doing this today. This is a wonderful tool, and it's one of those tools that every investor as well as real estate professional need to have in their arsenal, because you'll never know when you're going to need it.
Correct.
So was that a good slide?
Yeah, so then then they just make the payment directly to the seller. So that annuity issuer we set it up, they'll just get, we'll electronically deposit it in their bank account whenever it's due, or we can send a check. Most people in today's electronic age, we electronically deposit it directly to the seller. So,
and it magically the first of every month or 15th or whatever they structure it, it hits their account.
Correct.
Yep. And I have to tell you, and I know real estate brokers tend to oversimplify things. But what I'm hearing you say in how this works, it's exactly the same as a 1031 exchange. There's an intermediary. The funds are never really touched by SkySon. They go into guaranteed, investment vehicles, and then the money is then distributed after close of escrow as the principal or the client decides to take it.
That's correct. Now, I want to be clear that the seller is not buying an annuity or treasuries. They've agreed to payments. It's just now they're looking to, instead of a buyer, let's say, Joe Schmo who shows up and
might go bankrupt next year.
Yeah, it's a more creditworthy payer, and it's backed and guaranteed,
Well, and again, I don't want to oversimplify it, but I think it's a lot more than a more creditworthy. It is a creditworthy payer. Versus anybody else that really at some level, something could happen.
Absolutely. Yep.
When you're selling to Joe Schmo, even if you get $2 million down or $3 million down on that $10 million deal, that is not going to stop someone from going bankrupt. Things happen.
Yes, that's correct.
Sure. So this is a wonderful tool. So filing status, annual income for 2020. The reason I wanted to keep this slide in is I'd love for you to briefly talk about this a little bit, because I do know you've got capital gains. I know that a lot of folks don't understand the Medicare surtax and what they would really pay by the time they're done. And this slide, correct me if I'm wrong, doesn't even talk about something that you really can't put on a webinar like this, which is depreciation recapture, which would be on top of this.
Yeah, there can be depreciation recapture, and those are going to be subject to ordinary income tax. But as far as the capital gains, this kind of illustrates why you want to spread them out. Because so if you sold $5 million in cash, okay, you're going to be at the top level of 23.8. So what we do is by spreading it out over time. For example, if we can just keep your total income, that's why I said your individual situation. So you may have Social Security income and others, and that will come first. So that could push your capital gains. That's why we work with their CPAs to get a complete picture. But if we can keep your total income under, let's just say 496,000, we're going to reduce it from 20% to 15. So we're saving 5%. But if we can keep it down under 250,000, we avoid the additional 3.8 as well as the 5. So now you're at a flat 15. So we save the 8.8% in capital gains, federal capital gains tax. So if we keep your capital gains income under 80, it's zero. And again, we do, for some smaller clients that are just selling, 500,000, $1 million, $2 million, we can spread it out long enough and keep their capital gains under 80,000, their total income. It's 0% federal capital gain. So
you know what? I'm glad that you actually mentioned some of those smaller transactions. We actually have a question from someone that's on the webinar right now. I'd like to go ahead and let you field this question. It says, is there a size of transaction where this does or does not make sense? And then the second part of that question is, would this be feasible for someone with 2 rentals?
Absolutely. It starts making sense at about 250,000 as a rule of thumb. Some people, however, they really don't. We've had clients that said, I don't care about return. I don't care about anything. I just want a guaranteed payment.
Yep.
And if that's all they want, but that's up to them. We meet with them and say, what are you trying to achieve? What are your goals? But really, when it starts making, let's say if this only saved you $50,000 in taxes or 20,000, let's say, isn't that your 20,000 and for no cost to you? Wouldn't you rather keep 20,000 than give it to, to the government? So
absolutely.
We don't charge anybody. We'll meet, nobody ever writes us a check. We're paid by Principal Financial. It's all, when we say, here's your monthly payment and you agree to that, that's net of all the expenses that are in this. So, and
again, I'm going to remind those of you, I want to remind those of you who are watching this that are investors or real estate professionals. This illustration doesn't take depreciation recapture into account, whether it would be in your situation or would not. So do keep in mind, it could be more money beyond this that you're deferring, just like in a 1031 exchange.
Well, yeah, and that, when we meet with the CPA, they're going to know, we don't know how much is depreciation recapture, how much is gain, how much is, basis and all those things. So the CPA is going to know that. And they typically, when we show them this strategy, they'll say, okay, if I spread it out this long, they have kind of software that they plug it into and say, given all those variables, whether it's depreciation recapture, here's what your taxes are going to be. And they'll say, this is a good strategy. We're going to save X amount of dollars, and it's, it makes sense, or it doesn't make sense.
So when we started the webinar, we talked about all the different things and when you could utilize this. This slide illustrates some of those things. We got the sale of real estate, the sale of a privately held business, partial or failed 1031 exchange. And again, I'm going to highlight the word partial on that. As Rick said earlier, it's not all or nothing in this situation. But there is a couple of other areas, crop sales and broker commissions. Do you want to talk about all of this or those two things specifically, I certainly want to pick your brain on, being a real estate broker.
Yeah, exactly. Well, real quickly, real estate's, the obvious things in businesses. We work with some national business brokers and, we do a lot of dental practices and those type of things. And we're, in 1031. Now, the other thing with 1031s is you can no longer exchange personal property. We can still structure personal property. So you might exchange the real estate, the real property, and then have to defer taxes on the sale of personal property. So
I'll remind people, the crop sales can be considered personal property, right? The actual, it's grapes that come off a vineyard or fruit that come off an orchard. Is that correct?
Right. Well, in 1979, the dealer disposition rule, which is inventories, the rule on selling inventory, which you cannot do if it was like a manufacturer. You cannot sell inventory on installment sale basis except farming. So they can sell their production, whether it's trees, nuts, fruits, fur-bearing animal, anything that you're raising and cultivating for sale in an agricultural environment can be sold on installment sale basis. And so we can do crops, we can do grapes, we can do, if you have a fish farm, that's considering the farm bill as aquatic livestock. So,
those cannot be 1031 exchanged anymore. So
no.
Even if we're just utilizing, like you said, for a part of this, that eliminates the tax that would normally be on that. When it eliminates it, it structures it and it defers it, correct?
Correct.
Mm-hmm. Okay.
And then broker fees and commissions, this came out of, lobbyists for attorney fees.
And NAR, I'm sure, had something to do with this.
Well, not really. It was the plaintiff attorneys for their income, contingent income. But the way the IRS wrote it, it was kind of a blanket. Anybody with contingent income, which real estate brokers, if they don't sell it, they don't get paid, right? So it's contingent on the sale. They can enjoy tax deferral. So it's a little bit like a deferred comp. And it's a very simple agreement where the broker and the agent that says, look, I can be paid in cash or periodic payments.
So let's say I'm going to make $600,000 next year as a real estate broker, and I know that that's about where I'm going to do it, or whatever the case may be. Is there a way for me to accumulate that and structure that 600 at the end of the year, as opposed to taking it throughout the year as my closings take place?
I believe so. We would. So it's either, it's on how your payment agreement is. If you get paid quarterly, or if you say, you're not charged taxes until you're paid. So if the broker
is willing to amend the broker agreement between the agent and the broker on how they're paid.
Yep.
Then
we would review each situation and make our make sure that we're compliant in every situation. And again,
and again, I can't stress on that enough. Rick is who you need to talk to about your specific situation. At the end of this webinar, we're going to have all of Rick's contact information up. So I wanted to throw one of your examples in here. This was an example that you put together for your presentation. Do you want to take us through it?
Yeah, and this is, you mentioned rental property. This is an actual listing, from several years ago, on a rental property. He had it offer $750,000, bought it for $100,000. So he had purchased it, 20 years ago, and he had gains of $750,000. So
650.
I'm sorry.
Gains were 650, right?
Gains. So capital gains of 650. Now, obviously, there might be other. I'm simplifying this just to show the concept of how you can save money. So, So if he took monthly payments of $6,846.92 per month, which is $82,000 annually, beginning now. This is an older example, but it just shows time value for 10 years. Okay, so let's assume that. So we're going to compare it to a cash sale on the next slide. So go to the next slide.
Oh, I'm sorry. But yeah. I was getting stuck in the math. He's going to get over 10 years then, isn't he going to get like $821,000 as opposed to $750,000?
Yes.
Oh,
because the interest goes to the seller. So yeah.
Oh.
Yeah.
Okay.
So let's start with, so let's assume he did a cash sale. And so the capital gains are the same, but you're just going to be in there. So he'd have total capital gains taxes of $109,000 with Medicare surtax and everything, leaving him. I'm sorry?
I see that.
Okay. So with the 100,000, so he'd have $640,000 to invest, a little over. But if by doing the structured sale on the next slide, you can see the only interest being paid, okay, we're assuming no other income, would be on the interest earnings of $716 a year. You take the present value of that, it's $6,000. So we reduce their federal capital gains by 94.43%. We pay an annual income of $81,446 over 10 years. So a total of, like you said,
$821,000.
Oh,
yeah,
roughly $821,000. So,
and again, this is in a safe vehicle that's going to give this particular an investor 10 years of income, which is how they structured it.
Right, absolutely guaranteed in writing. Correct.
That's a beautiful thing. So the benefits
of that?
End
up with, income from the sale is paid at 0% federal capital gains. You still have state, but we can't. Most of those start first dollar, and so we can't change those. But if we can reduce that 23.8%, so to equal that same income coming out from the structured sale, you have advisors say, "Oh, just pay the tax. I'll make it up in the market." So they would have to invest that $640,330 after a cash sale. They would have had to earn 10.31% every day, every week, every month for 10 years to equal this payout. All guaranteed.
And again, a 10.31% return in real estate or business or whatever, that's going to come with some risk. That as a broker that's done this for 20 years, that's going to come with a boatload of risk.
Right. You can't get 10.31% in the market. There's nothing.
Even if I can, it would have so much risk attached to it, which would equate to many periods of time without income. Period.
Correct.
That's it.
Especially if you're taking income, because now you can't get that back. You would have to earn, you lose 50% in the market. You got to get 100% to get it back, just to get back to even.
Wow.
So, Yeah. And again, they cannot go after that, $750,000 sitting in the trust.
So, and again, with the 1031 exchanges, this is structured sales strategies in a 1031 exchange.
Right.
Obviously, contingency fallback. This is what I call a 1031 exchange safety blanket.
Correct.
Since I've met Rick, that's what I've been calling it with my clients. It's a 1031 exchange safety blanket. It deals with boot. But you know what? It's more than a 1031 exchange safety blanket, because as a real estate broker who deals with investments, I don't believe you should have all of your assets, all of your money tied up in real estate. Number one. You should be somewhat diversified. But as you're moving into retirement, we want less headache. We want little to no risk. We want to know that in our retirement or golden years, we're going to actually have income without hiccups.
Correct.
And this is a fantastic way to do it. You said to help a seller. Now, you want to expand on that a little bit?
So, well, and those should be kind of over cash out and personal property. So now, what do you do if you've got personal property that's part of the sale? We can help with that. If, again, you may be doing a partial 1031. How do we handle the personal property? Now, cash out, that would be more in the agricultural arena, because another one of the exemptions in the code for Section 453 installment sales is you can borrow against that or collateralize that payment stream, and it's tax-free. So if you're agriculture, so let's say you have a vineyard or a farm or row crop, you could sell all those crops in the bin or whatever, spread your taxes out over 10 years, but take a lump sum tax-free right now.
Are you saying I can basically assign those payments wherever it is for the loan, and because borrowed money is not taxable, if I'm selling agricultural money, then I just have a lump of tax-free money now that I can deploy into an RV and whatever I want?
Absolutely. Without disrupting your tax deferral strategy.
Because
But
that's still
again,
taking
that's
place in
only
the
for
background.
agriculture.
It's just the payments are then just going to go to satisfy the debt.
Correct. And that's how
Wow.
we set it up. It will automatically go. So what we do is we direct the payments to the bank, and we're not bankers. We developed and spoke with the bank who can do this nationwide. We're not here to disrupt your local. If they want to do it, they can do it. We can show them how. But in order to, if we're going to tell people they can do it, we wanted to have an option that we knew would do it.
Mm-hmm.
But we would direct the payments from the trust directly irrevocably to the bank. They sweep the payment and pass through what's left to the seller. So you may
So they don't have to borrow all the money. They could borrow half of the value of their payments,
right,
and let the other half continue to make them periodic payments. But they came up to some need, that maybe that $5 million buyer had some million or $1.5 million situation. They could just take $1 million, $1.5 million out of it and let the periodic payments continue on the balance. Is that correct?
That's correct. And you don't have to do it at the time of sale. So we get asked a lot, well, what if I need money in the future? So let's say I sold my farm for $10 million. And 2 years later, my wife wants to buy a store, or they want to buy, $1 million cabin somewhere.
Sure.
Well, instead of, going and paying, taking money out taxable, you can simply go get a loan against those payments, liquidate $1 million tax-free and go buy the property 2 years from now with tax-free dollars, and it just would automatically pay itself off, and the balance would continue to come to you.
And I know people latch on when you say tax-free dollars. He's not kidding. Borrowed money is not taxable. So it is absolutely tax-free money.
And again, and this is for agriculture, is specifically exempted. If it was non-agriculture, you could still borrow against it, but it would accelerate the taxes as if it was a payment from the installment sale.
Right. So it's less advantageous unless it's a agricultural property.
Right. But either way, it's a way to have some liquidity.
Wow.
Non-ag, you're going to pay. You're going to pay
the taxes. So if I sold my apartment in an emergency, I could get money.
Right, but instead of, paying all the taxes up front, you're only going to pay taxes if you need it and when you need it, and on the amount that you need.
So it's if you're in a situation where you're in a 1031, you have this as a safety blanket, you set it up. The worst case scenario is you could take your cash out better.
Correct.
And when you want to.
Portion.
And again,
Correct.
I know I'm being a real estate broker and oversimplifying, but this is a reason, folks, if you're listening to this is a reason to give Rick a call and discuss your personal situation. Do we want to go over this final slide? I think this is just really talking about what we talked about, right?
Right. Yeah. And succession planning, for example, so it's a way for CPAs, and I say farmers because a lot of the presentation this was drawn from was for agriculture, but it's a way to control your taxes. So basically, if you can control your income, you can control your taxes. It can give a broker like yourself an ability, or farmers with crops, because good years, bad years, rain, drought, a way to stabilize their income through controlling their taxes and controlling cash flows. Succession planning is a big issue. So let's say you've got a property and it's owned by three kids. They were inherited it 10 years ago and now they're ready to sell. Well, one kid wants cash, one wants to take payments now, and one doesn't need it. They want to defer payment. So all of them can get the cash flow that they need or want
without affecting the other.
Without affecting the other, exactly.
Okay.
And then stacking income for retirement, that's either in agriculture or a real estate broker, or let's say you own 20 rental properties. You can just start selling them as you get good opportunities and you go, I'm never going to, you can start, like you said, take payments at your projected retirement age. Enhanced creditor protection, we've talked about that in the tax-free liquidity in agriculture. You have that pledge loan opportunity as well.
Wow. And this is just a good tool. So again, just to review, Rick, go ahead and finish this slide off.
Okay, so really this kind of all the same things. I think the big one at the bottom is nobody ever writes us a check. If we came out and worked with you and spent several days, and we talk to your tax advisor and the buyer, and you get to closing and you say, you know what, we're just going to take the cash.
Mhm.
You know what, we don't get paid. So we kind of take that risk as well. We feel it's a good strategy for the right situation and the right person looking for what we bring to the table, but we're never going to charge you. So
that's a big fee. Well, how do you get income?
Well, we get paid on the back end. So if they're buying treasuries, we carve it small. We make about 1.5%
Okay.
over time, the same time limit that that they're taking it. So there's not a lot there to carve out because we can't take it all.
Sure.
So we make a little on each transaction, but it's built into those payments. So
well, and that's pretty
81,000
attractive.
a year. If you
That's-
go back to that example, that's
Yeah.
net of everybody's fees. We got to pay principal trust. We pay
Right.
an investment advisor to ladder bonds, but that's all in there. That's all net of that. So
Beautiful. And then, of course, Rick, how's the best way to get a hold of you? And why don't you introduce Andrew and Corey so that people know that they can talk to them as well?
Sure. The top is our 800 line, so they can call in toll free. Andrew is actually in Modesto, California. He's on, busy there, but so he's local and can get out and see you locally there. And I think you've met Andrew.
Absolutely.
Spoken with him. I'm in Iowa. And Corey Millers are also in Iowa. He's our national sales manager. So any one of these three here, any one of us can answer questions and talk to your CPA and
Sure.
help you out.
Perfect. So if you're interested, definitely call Rick, call Andrew, call Corey. Remember www.skysonfinancial.com if you want to do a little bit more digging around on your own. And if you want to, you can always call me. You can call myself. You can call Dusty Bates. I am at 916-798-1116. We can help you ourselves with broker opinion of values, demographic rent surveys, listings. We help Delaware statutory trust funds. We can set you up with those. 1031 exchange companies, cost segregation engineers, but most importantly for this situation, structured sales from SkySon Financial. You know what? This is something that if you've been an investor, even if you're not doing anything this year or next year, give Rick a call, because this is the kind of thing that you need to have in your quiver. It's another arrow that just helps you manage your money. Rick, thank you very much for being our guest today. I know that Dusty's going to work with you tomorrow. We're going to have a little 6 or 5 minute training on this, a little fast action stuff. And we can always get more detailed with anybody. Like I say, give Rick a call, give myself a call, and thank you very much for listening. Rick, thank you and have a great day.
Thank you. Appreciate it.
All right. Bye-bye.